next book is One Good Trade by Mike Bellafiore. Mike Bellafiore is a well-known figure in the trading community, and he's the co-founder of SMB Capital, a prop firm located in New York City. Bellafiore's book offers a lot of great insights to his approach to trading and some of his strategies for success in the financial markets. Also, Mike is respected for his emphasis on disciplined trading, risk management, and continuous learning, which are all essential elements for a trading career. So the overall premise of this book is one good trade. In the second chapter of the book, the first paragraph states, "Do not judge a trade based upon its results. A profitable trade may or may not have been a good trade. What I call one good trade. A loser may have been one good trade. If your fundamentals for a trade are sound, then that is one good trade. Consistently profitable traders obsess about making one good trade and not money. Your job is to make one good trade and then one good trade and then one good trade." There is so much wisdom in that paragraph. And I think a big misconception in the trading community, especially with newer traders coming into the market, they might define one good trade as a trade that you make money on. The tricky thing about the stock market is it's the only place where you can go and be rewarded for doing the wrong thing. That's positive reinforcement for bad habits. But the trickiest part about the stock market is you might not even know right away what bad habits you're implementing. So you don't even realize you're getting rewarded for doing the things that you shouldn't be doing. And the one way we can get around that is by defining what our process is, defining what our system is, so that we know if we took or are taking a good trade. Now, if we define our process, we define our system, we're making sure we get into trades that make sense. The odds are in my favor. The risk to reward on this trade makes sense. Maybe I'm risking one to make two. Maybe I'm risking one to make three. And if I'm risking one to make one or a little less, I better have a higher odds on my trade for that trade to make sense, because we want to combine the risk to reward ratio with the probability of profit on that trade to find trades that make sense. Because we don't really want to be taking trades where we're risking, 3 to make one, or we're risking 4 to make one, or we're risking 5 to make one. Those type of trades may not make sense, and it's going to be hard to stay ahead of the curve in the long run when you go through inevitable losses. So one good trade, what is one good trade to you? Define those things, write them down, and then you'll be able to identify if you did anything that was outside of your process or your system. And then you'll be able to define if I took a good trade or if I didn't take a good trade. Now, everybody's trading process or everybody's trading system is completely different. There's no one way or one right way to go about things. But at the end of the day, what I need to see with my trading process and my system that I trade, the odds need to, one, be in my favor. And then the risk to reward ratio paired with those odds need to make sense. So am I taking trades where I'm, risking 3 units of risk to potentially make one, or risking 4, 5, or 6 units of risk to potentially make 1 unit of risk? Those type of trades wouldn't really make too much sense to me. Now, if I'm risking 1 to make 2, I like those odds a little better. I like that risk to reward. If I'm risking 1 to make 3, even better. But if I'm ever risking 1 to 1 or risking 2 units to make 1, the odds on that trade need to be very high for it to make sense to take those trades in the long run. So define your trading process. Define what one good trade is to you. It doesn't mean you made money on the trade, but define what your process looks like and see if you have any behaviors or any impulsive actions that are outside of that process, and then you can define that as one good trade. The next book that I have is The Unlucky Investor's Guide to Options Trading by Julia Spina, forwarded by Tom Sosnoff. So Julia Spina is on the research team of Tasty Live, and Julia is literally one of the smartest people I've ever met. Her dad is a literal rocket scientist, so it's not the apple didn't fall very far from the tree, I'll tell you that much. So Tom Sosnoff is another well-known figure in the trading and finance industry. He's an entrepreneur, options trader, media personality, and he was a co-founder of Thinkorswim, one of the most popular trading platforms in the industry. He later then founded Tasty Trade, and Tom Sosnoff is recognized for his contributions to the trading community and for his efforts to democratize access to financial markets through technology and education. So the overall purpose of this book is to really level the playing field when it comes down to managing a portfolio and trading within the stock market. Tom has decades of experience, and Tom shares all the knowledge, all the education that's needed to be able to trade like the pros. And it shows what the pros are actually doing, which is selling options. So if you're somebody that buys options, you're somebody that trades futures, it talks about all those things in this book. But if you're not familiar with selling options and why selling options have an edge in itself, this is the book for you. Options are precisely customizable financial assets that have the capacity to generate profits in any type of market environment. For more risk-tolerant traders, they can be used to build reliable investment strategies tailored according to one's personal profit goals and risk preferences. Investors often fall into the trap of focusing on the potential rewards of options without properly assessing the associated risks or building strategies that are not backed by statistics. So Tom Sosnoff has decades of experience, and one thing that Tom has done is democratize the playing field. There's a lot of things that pros are doing. There's a lot of different strategies and different ways that pros go about investing and trading, and Tom relays all the information, all the education needed to play the game the same way that they play. And one of those ways is by selling options. And selling options give you an edge in the long term. If you're buying options, that's fine. If you're buying or selling futures, that's perfectly fine, but selling options are unique in this way. Selling options for profit is like owning the slot machines. Casino owners have the long run statistical advantage for every game, an edge particularly high for slots. Owners may occasionally pay out large jackpots, but as long as people play enough and the payouts are manageable, they are compensated for taking this risk with nearly guaranteed profit in the long term. So selling options doesn't mean it's some cheat code. Selling options doesn't mean it's a holy grail strategy or approach to the market. But what it does let you know is there is an edge with selling options in the long term. So that must tell you that buying options in the long term, there's not much of an edge there. And there are certain strategies that benefit the most from selling options. And the way that I like to think about it is you don't need to know how to sell options, but there are certain cases where selling options might be more wise. For example, let's say we have a nail and we're trying to get this nail in the wall, and I have a set of tools that I can use, right? In reference to the tools, I'm talking about, maybe selling options, buying futures, selling futures, using stock, whatever it is. But let's say we're trying to get this nail in the wall. I have a screwdriver, I have a hammer, and I have a wrench. It's like, okay, I have 3 tools to choose from. I could use the screwdriver. I can maybe use the back of the handle on the screwdriver, get that nail in the wall. I got a wrench. It's kind of flat. Maybe I can use the side of the wrench to get that nail in the wall, and I could get the job done. Or I could just use the hammer and get that nail in the wall. It's like I can get the nail in the wall using all of these tools, but which one of these tools is going to be most efficient? And that's the way I like to view the tools of the stock market. Yes, I could have bought stock or sold stock in this scenario. Yes, I could have bought futures. Yes, I could have done this, I could have done that. But maybe in this case, selling options would have been the most efficient way to go about this process. So if you're somebody that's kind of steered away from options because they seem a little intimidating, this book will break down and explain to you all the Greeks associated with the options, how the price of the options move, what extrinsic value is, what an intrinsic value is. It'll lay out the whole 9 yards for you so you can break down what options are and eventually implement them into your portfolio. Now, dabble in options and eventually implement that into your portfolio. The Unlucky Investor's Guide is probably the best book that you can find that talks about selling options and options in general. Now, the next book we have is The Daily Trading Coach by Dr. Steinbarger, which is an absolute gem. And Dr. Steinbarger is a prominent figure in the field of trading psychology and performance coaching. He's a clinical psychologist, an active trader who has combined expertise in psychology with his passion for trading to help traders improve their performance. It's probably my favorite trading book. I've read it over and over again. It's kind of like reading the Bible. You've read that before, but now that you read it again, you take something a little different from it, or you have a little different perspective on it because you have a different experience that you went through. So now you might perceive this information a little different. This book has about 10 chapters with 100 lessons in them. And there are way too many lessons to choose from, like relapse and repetition, building your consistency, crystallizing your repetitive patterns, finding positive trading relationships, the power of discrepancy, building emotional resilience. There's so many great lessons in this book, but I'm going to touch on one of my favorites, which is the chapter and lesson talking about how to build self-confidence and why self-confidence in the market is so important. Now, trading is one of the most challenging occupations because traders routinely face working conditions that they cannot control. Psychological research suggests that one important basis for self-confidence is self-efficacy, the perception that we can control outcomes that are important to us. But how can we sustain self-confidence as traders if we cannot control whether or not we make money day to day, week to week, or month in, month out? In my opinion, the psychology of a trader is one of the most important factors and is one of the most important skill sets I think anybody in the market needs to learn. Gaining confidence really starts with identifying the things that we can control and the things that we can't control. And the things we can control is when we get into a trade, what underlying we get into, how we get into the trade, and when we get out of the trade. But the one thing we can control, the only thing we can control in the market is how much we lose. We can't even control necessarily how much we make. We can have an idea about what we might make. We can also have an idea about how much we might lose. But at the end of the day, the only thing you can control is how much you lose. You can't even control necessarily if you're going to take a red trade. You can have all the conviction you want, all the odds in your favor, but because of the nature of the market, you can't even control whether or not the outcome of that trade is going to be green or red. But again, the one thing we can control is how much we lose on a trade. And my biggest takeaway of this section, speaking about self-confidence, is confidence doesn't come from being right all the time. It comes from surviving the many occasions of being wrong. Think about that. Think about that in your daily life and anything that you do. If you understand that you can handle the worst of the worst, you can handle when you slip up, you can handle this, you can handle what life throws at you, you're gonna become a lot more confident because you're gonna realize, I've been here before, I can handle this. You're not gonna gain confidence from making the right decisions. Yeah, that might add to it, but once you realize you can manage your trades, you can manage yourself in the market and your trade position for when things go south, you're gonna be a lot more confident than when those trades are going your way. Because now you're not gonna be scared to pull the trigger. You're gonna add to your positions. You're gonna get out where you need to. Because where does trading hesitation really come from? It usually comes from our past experiences, us scarring ourselves, and then us being hesitant to hit the button when we know we need to hit the button. So building self-confidence truly comes down from handling the many occasions when you were wrong.